Is Google or Alphabet stock still worth investing in today, or is most of the growth behind us and better opportunities to be found elsewhere? In today's video, I'm going to give you a quick 5-minute breakdown of both sides of the equation, bull and bear, and give you my take on what I think the deal is. Without wasting any time, let's get right into it. Okay, let's start with the bull side of the argument. And one of the major points in Google's favor is that they essentially have a search monopoly. I know there's technically other alternatives out there, but realistically, when 90% of the world goes to search something up, they go to Google. Google is literally a verb, and the number of people that use the alternatives like DuckDuckGo or Bing search really pales in comparison. And the near monopoly that Google has with search gives them massive and sustainable ad revenue that supports their other business lines. Speaking of other business lines, Google also owns YouTube, which is one of the fastest growing video platforms and really the largest that focuses on user-generated content. Apparently, there are 5 billion video views on YouTube every single day. 5 billion. That is 5 billion pairs of eyeballs and 5 billion opportunities for Google to show ads to people, and that attention can be translated into cash. Fun fact, Google search and YouTube are the two most visited websites on the internet, and Google owns them both. In addition to all that, you've got Google's cloud service business and other B2B products, and then there's a number of other consumer-focused products like Gmail, Android operating system, Google Maps, Fitbit, and on and on and on. All of these business lines amount to over $250 billion in revenue in 2021, of which 76 billion was profit. And what's even crazier is that gross income grew by 41% and net income, or the profit of the business, grew by over 90% in 2021 alone. So even though Google is a behemoth that's pretty mature because it's been around for a relatively long time, they're still growing at an incredibly rapid clip that's pretty much on par with early stage growth companies. But what to do with all that profit that Google is generating quarter over quarter, year over year? Well, reinvest it, of course. Google is making huge investments in AI, which will have ripple effects with efficiency gains throughout all aspects of its business. And another thing that they're doing with all that spare cash is going out and acquiring new companies. In fact, since Google was launched, they have acquired over 230 companies. And just this week, actually, they announced a new deal for $5.4 billion to buy a cybersecurity firm named Mandiant, although I'm probably butchering that name. And there's a lot of other reasons to like Google as well, including the fact that they're continuously investing in research and development, the fact that they're hiring some of the best and brightest software and AI engineers in the world, the fact that they have an impeccable financial position and that they do share buybacks, and so on and so forth. But now let's focus for a minute on the bear side of the argument, because it's not all rainbows and roses for this company. And there's really two main bear arguments to highlight. The first is the risk of regulation or antitrust actions against the company. Because, like I already mentioned, they have a monopoly or a near monopoly position in a few of their business lines, there is a pretty significant risk that at some point in the future, lawmakers will attempt to either hamstring the company or, even worst case scenario, break it up into its component parts. The second biggest risk to Google is of competition. So for example, there's competition in the digital advertising revenue that's coming from places that wasn't there before. For example, Amazon has actually emerged and is trying to take Google's lunch. And there's also obviously pretty fierce competition in sectors like cloud services, where Amazon and also Microsoft are competing pretty heavily, which is putting downward pressure on the price of those services and impacting Google's bottom line. Now, another potential bear argument to mention here, although it's not necessarily a huge one, is the fact that Google is no longer founder-led. Larry Page, who was co-founder of the company and CEO for a very long time, stepped down in 2019 and was replaced by somebody that wasn't there at the beginning. And the risk there, or at least what some people say is a risk, is that there might be less vision and less innovation. And one final bear argument that I'll mention here is that Google makes a lot of big, risky investments in what are called moonshot technologies. These really far-fetched ideas that, if they actually pan out, could pay off in a really significant way, but if they don't, they have to get written off completely. And a good example of this was a recent project that was actually just canceled a couple of months ago called Loon, where Google was experimenting with using high-altitude balloons to provide bandwidth or data service to people that lived in rural or remote areas. And that project was really a money sink, and that's the risk with Loon or other moonshot technology investments, which Google has made quite a few of. I guess the issue is that as companies get larger and larger, and with Google being absolutely massive, they become less capital efficient and have to work a lot harder to try and find new ways to be innovative, to push the envelope that can actually make money. Okay, so what's my take here? Well, in the end, I actually think that the bull side of the argument wins the case handily. Of course, there are definitely some risks, but really the financial position of the company, the fact that it has near monopolies in a couple of its business lines, and just the continuous profits that they are churning out is absolutely astounding for a company that is actually so mature. And while the company's stock is certainly expensive, it's not necessarily overvalued. In fact, as of the time of this recording, Google had a price to earnings or a PE ratio of around 22, which for the tech sector is definitely not high. I'm currently a small investor in Google, but I'm actively considering increasing the size of my position. Anyways, that's it for today's video. Hope you enjoyed it. If you did, you might also like this one or this one. Have yourself a great day.